TV18.
First take on the index is in the green, up almost about 40 odd points.
The Nifty is off its highs by close to about 30 odd points.
We have, of course, a market that is holding on to its gains from earlier in the morning.
You got a bit of a cool-off which has happened on the Nifty. This is the last, 5-7 minutes of trade, another 40 odd points added on. It was up very smartly early on, did in the mid-session also was looking quite good, but would end just 38 points, 40 points higher, which is about 0.25%, 0.2% or so.
Watching us here on Markets Today, good evening. This is a show where we talk about all the 6 hours of trading in 5 headlines. It was an interesting day of trade. We did well for most part of the day, barring the last few minutes where we did see a bit of a sell-off from the highs, understandably ahead of the US Fed meet outcome. The Midcap index, however, continued to outperform, and that was the big story of the day. Let's talk about all those top headlines then. Stock markets tread with caution across the world ahead of the US Fed rate's decision. Sensex and the Nifty ends with minor gains. Banks lead from the front, with that index posting a record close for second day in a row to rise above that 44,000 mark, and mid-caps outperform benchmarks while IT stocks rise, tracking the gains on the Nasdaq. Paytm stock slips 2% after board's approval of an 850 crore rupee buyback via the open market, which disappoints investors. The maximum buyback price of 810 rupees, which is a premium to the current share price, offers the market little solace given it's a market buyback. Gold shines hitting a 6-month high as investors turn to safer havens amidst geopolitical tensions, recession concerns, and evolving COVID variants, while supply woes continue to push crude prices higher, even as softer than expected US inflation aids sentiment. Colgate stocks rise 4% as analysts remain circumspect on the company's new CEO's growth plan, while Yes Bank loses 7.5% after Morgan Stanley initiates coverage on the stock with an underweight rating. Dr. Lal Pathlabs gains after the management tells CNBC-TV18 that the Delhi government plans to offer free medical tests will not hurt the diagnostics player, while positive commentary and a buy call from Spark Capital gives Nalco and Hindalco a boost. Let's tell you what you have for the show today, what you can expect. It's a packed show. We have Dheeraj Agarwal of Ambit Capital, Robert Sorkin, global economist at Citi, and a big corporate voices. We do have Sunita Reddy of Apollo Hospitals joining in on the show as well. Let's talk about the action straight from Dalal Street. Then it was a day of good gains for the Nifty, barring the last hour where we did see a bit of a trepidation ahead of the big FOMC meet outcome. But the mid-cap index suggests that there is no real problem as far as the direction of the markets are concerned. Broader markets doing extremely well, 1,600 stocks ending higher for about 1,200 ending lower. To get us more details, Prashant Nair joins in.
Well, the market ended not with a whimper, but not with a roar either. The market was looking much stronger early on. Mid-session, it looked strong, but did come off quite a bit. The Nifty ending with just about 0.25% odd in terms of gains. Banks, which have been the stronger of the two indices, also came off and ended only marginally higher. PSU banks, no problems, even they continued to march ahead. Although what is leading that pack is maybe the lower quality names within the PSU banking space. Otherwise, I mean, sectorally, there was not a problem, except FMCG. Most sectors were higher, gains coming through in real estate, metals, and the IT services space, which for the second day bounced a little bit. Some stability returning, especially in mid-cap names. I'll get to stocks. So the Nifty gains coming through in names like Eicher Motors, Tata Steel, Tech Mahindra, State Bank of India, IndusInd Bank, and a few others. Cuts in FMCG, as I said. HUL was down. You had SBI Life and Ultratech, which also gave up some of those gains. Broader markets, lots of action and advances far outnumbering, losers. Mid-caps and small caps did do very well. UCO Bank, RBL, Suzlon, PNB Housing, GICRE, TV18 Broadcast, Punjab and Sindh Bank, and a whole host of other names. And we're only kind of going through the top volume-led gainers that we had today. Losers also, Yes Bank has had a fantastic last couple of days. That ended lower. Page Industries was down, Colgate was lower, and names like Reddington, which have seen a decent run-up, lost a little bit as well. Neither here nor there. Tonight's session in the US will be important because of the Fed decision, and I think that sets the course, sets the tune when we return tomorrow. Back to you.
Take that point, Prashant. In fact, let's also get into market opinion coming in from Dheeraj Agarwal, who's the co-head equities at Ambit Capital. He said that expecting a runaway move in the Nifty will actually be futile at this point, and understandably so as well, given the sort of outlook that the world has in terms of global recession, but at the same time, given the outperformance that we've seen for our markets as well and the valuations that we trade at. Let's listen in.
Markets and positive sentiment time can actually stretch to, while there is a EY/BY mean value, there's, if you look at the maximum gap it can create, and then maximum level it can possibly go to 20,000, 20,500 range. Anything beyond that, I think, is going to be a little bit of a stretch. So while a lot of headwinds have receded, possibly a lot of that headwinds receding is already getting reflected in the valuations. So it's trending up. I think it'll be more of a stock pickers market going into next year. Expecting a runaway Nifty is going to be a little bit of an over-optimism. They're very positive in India. They're very positive in Indian economy, Indian markets over the next 5 years, but they find hard to pick stock ideas. So that's a very interesting paradox. You like the markets, but you're not able to convince yourself to buy individual names in the market. So that obviously tells you that it's not the structural outlook, it's not the fundamental outlook, but it's the valuation of the price, which is a little bit of a deterrent at this point. China, people are looking at, China is a strange case. Everybody wants to go there and everybody's scared to go there. So I think the few bolder investors have made a move towards China. But the recent memory of what happened in China and what happened in some of the other emerging markets.
All right, that is Dheeraj Agarwal's views, but the US Federal Reserve will announce the final rate decision for the year later tonight. As per a survey conducted by CNBC, the market is bracing for a 50 basis points rate hike in the benchmark rates. What's crucial, however, is if Fed Chief Jerome Powell's post-conference commentary and their projections going forward will indicate that they are done, or will they continue to increase interest rates and continue with their policy. CNBC's Steve Leisman gets us all the highlights from the latest CNBC Fed survey.
The Fed is seen hiking 50 basis points at the meeting this week and adding another 75 next year, and causing what 2/3 of the respondents to the CNBC Fed survey believe will be a recession. But there is a small contingent, we'll look at that in a second, that's optimistic a contraction of the economy can be avoided. Here are what we call the Fed expectations. 50 this week. The new rate is going to be 4.25 to 4.5. The peak rate is seen at 5.15. That's higher than the Fed funds futures market. So this group of 34 folks think they're going to be a more aggressive Fed. The final hike comes in April, and then the Fed cruises at that speed, at that rate for 9 months. Here's the outlook from this group. 388 now goes to 438. That's between 4.25 and 4.5. 5.15 is the peak rate, and then some adjusting going on towards the end of the year, and maybe some rate cuts through 2024, ending at 380 for December 2024. Here's the recession outlook. 61% think there's going to be a recession in the next year. The average start date is in June of 2023. That is, by the way, 2 months later than the prior survey, and we've seen that in some of the Wall Street forecasts, pushing it down the road. Average length is a pretty long one, 15 months, with 67% believing it will be moderate, and about 33% think it's going to be mild. Here's the GDP outlook, and you can see 2 quarters of negative growth built in Q2 and Q3 of next year. Again, that's a quarter later for the 2 negative quarters there. But here's a little bit of optimism here. Does the Fed tighten too much, we ask, and cause a recession? That's 59%. Sorry, that's down from 71%. Is it just right? And there's that contingent of optimists right there. 24% think the Fed gets it just right. That's up from 9%. It had been higher in the past. And does the Fed tighten too little and not get inflation under control? 15% down from 20. So a little bit more optimism in there. Recession, though, remains the base case for most of the 34 respondents.
All right, we take that point, Steve. Thanks a lot for that. Robert Sokin, who's the global economist at Citi, also said that it's too soon to say if Fed will actually begin to pause rate hikes. Let's take a look.
Tomorrow, I think, is fairly baked in, a 50 basis point hike that's been very well telegraphed. I still think they're going to lean hawkish tomorrow, and it's too soon to say whether they can start to think about pausing or starting to think about even cutting. I think what's clear is, and they've made this clear in recent Fed speak, is they want to slow down the pace of hikes. But I still think it's likely that they're not going to be committal on where the terminal rate and the risks around there are ultimately going to go. I think the dots tomorrow are going to still show a 50 basis point increase relative to September, so it's going to be above 5%.
All right, with that, let's move on to the second headline now. Paytm stock was lower by almost 2% after the board's approval of an 850 crore rupee buyback via the open market disappointed investors. It wasn't the amount or the price, it was basically the fact that they chose the market route for buyback as against tender, which made the maximum buyback price of almost 810 rupees a share, which is a premium of 50% of the current market share price, almost pointless and offered little solace. Abhishek joins in with more on the specifics of the buyback.
Well, Paytm has announced buyback amounting to about 850 crores rupees. So this forms about 10.24% of the fresh issue that they did last year in November, and about 9.26% of the cash and cash equivalent that they have in the balance sheet, which is about 9,180 odd crores. So the maximum price for buyback that they have mentioned is 810 per share, which is a discount of more than 62% to the IPO price of 2,150 per share. The buyback forms about 1.62% of the equity. The minimum buyback that they have announced is 50% of the amount, which is about 425 crore. The method of buyback is open offer. Now, this is against the tender offer that was on radar of many analysts to be completed in 6 months time frame with respect to timeline being given for the buyback. The total cost, including all the expenses, would be about 1,048 crore for the company. Back to you.
Take that point, Abhishek. Thanks a lot for that. Let's talk about the third headline today. Gold has literally struck gold. It's a 6-month high as investors turn to the yellow metal in search of a safe haven amidst geopolitical tensions, there's recession concerns, and evolving COVID variants as well. Manisha Gupta joins in with more on the yellow metal. Manisha.
Well, it has been a good going for gold prices, trading at nearly 6-month highs. $1,800 per ounce is back, and we have turned positive for the month and for the year for gold, more so in the Indian currency with the kind of depreciation that we have seen come in for the rupee. Well, the concerns about recession, also the decline in dollar index have been supportive factors. Give it also the recession concerns that the street is looking at, higher inflation numbers, all of that does weave into the prices. Much of the gains in gold come in from the fact that we are looking at short covering. The new longs is only 10 to 12% right now. So that is something that the street will need to watch out for. But when you look at the last 5 years, it only has been 1 year that has seen a decline or a negative return in case of gold. The other years have seen positive ones. Outlook for 2023 also seems to be on the positive side. The only one conservative, or let's call it bearish view, has come in from Metal Focus to the tune of $1,650 per ounce for the next year. Most other banks and brokerages are talking about $1,850 per ounce on the higher side. That is what Fit Solutions says. And $2,000 per ounce plus kind of levels are coming in from Saxo Bank, Standard Chartered, Nirmal Bang, and Indian Brokerage. All of them expect that the gold prices could be hitting newer highs in dollar terms in next year.
All right, new highs in dollar terms over the next year will be interesting to see. But Manisha, hang in there. Crude prices, they continue to rise as well. And this after the news that the Canada-US Keystone pipeline leak and the closure will disrupt supply for weeks. This even as softer than expected US inflation aid sentiment.
$80 is back on Brent crude oil prices, and we have seen nearly 6% of gains happen in this week after 10% of a decline in the previous week. So much of ground clearly has been taken again. The support comes in from the fact that the Keystone pipeline, which runs from Canada to the refiners in US, is shut and could be shut for some weeks, is what is adding premium to prices. Add to that the fact that while there are supply disruptions, you could be looking at Chinese market reopening. The month of November has seen crude oil imports by nearly to the tune of 11%. So that clearly has been supportive. And then it is also about the decline in dollar index back below 105. We have seen the dollar index decline by nearly 8% since the month of October. And the baking in of the event that the US Fed rate hike could be about 50 basis points also seems to be supporting the crude oil prices. Markets do believe that as we go ahead, there are underinvestments in crude, but the demand hasn't peaked out yet, and that in 2023 and 24 will continue to support the crude oil prices.
All right, Manisha, thanks a lot for that. Let's take a short break now, but you stay tuned. We'll be back in a jiffy. with all the other headlines.